This question will walk through the accounting for troubled debt modification. On December 31st, 2020, Red Bank enters into a debt restructuring agreement with Troubled Inc., which is now experiencing financial trouble. The bank agrees to restructure a $2 million 12% note receivable issued at par by the following modifications: reducing the principal obligation from $2 million to $1.9 million, extending the maturity date from December 31st, 2020 to December 31st, 2023, reducing the interest rate from 12% to 10%. Troubled pays interest at the end of each year. On January 1st, 2024, Troubled Inc. pays $1.9 million in cash to Red Bank. Troubled prepares financial statements in accordance with IFRS 9. And in part 1, we're asked to A, determine whether or not Troubled should record a gain, B, prepare an entry at December 31st, 2020 based on the results of your calculation, C, prepare an effective interest amortization table for the remaining term of the note, D, prepare the interest payment entry for Troubled on December 31st, 2022, and the interest on January 1st, 2024. And then in E, we're asked to assume instead that Troubled follows ASPE. So let's get started with part A, B, and C, and D. So let's take a look here. So the first thing that we need to do is figure out if the present value of the new debt is greater than 10% different from the present value of the old debt. So present value of new debt or new debt arrangement versus present value of the old debt. And what's this going to tell us? Well, if the difference between these two things is less than 10%, then we have a modification of debt. If the difference is greater than 10%, we have a settlement of the old debt, and we have a brand new debt that we're going to start recording from day one. So it has quite a significant accounting implication. So do we know either of these two things? Well, we don't know the present value of the new debt yet. We're going to need to calculate that. The present value of the old debt, if we go up to the question, it was a $2 million note, and it was due on December 31st, 2020. And now the bank agrees to restructure, extending the maturity date. So the maturity date was December 31st, 2020, and this restructuring is happening on December 31st, 2020. So what does that mean? It means that the old note was actually due now, and they realized, presumably, Red Bank realized that Troubled Inc. wouldn't be able to pay the principal back, and so they extended the terms and made some other changes. So what that means is that the present value of this $2 million note is $2 million, because we know that the debt has to be recorded at the present value on the statement of financial position at maturity, and it's maturity right now. So we know that that's $2 million, but we don't know this yet. So let's calculate the present value of the new debt. So what do we know about the new debt? Let's take a look up here. So we know that the new debt is going to have a new principal of 1.9. It's being extended from December 31st, 2020 to December 31st, 2023. So this is 3 years. It's due in 3 years. And we're given a couple different interest rates here. And let's talk about that. So let's go back down and talk about what inputs we're going to put into our financial calculator. So we know that the future value of the new note is going to be 1.9 million, because that is the principal value that we just saw above. We know that N is going to be 3, because it's 3 years, which we just saw the extension, December 31st, 2020 to December 31st, 2023. I think it was. Yep. And what is I going to be? And this is a really important question. So if you look up in the question, it says that the interest rate on the new debt, or the interest rate, has been reduced from 12% to 10%. So it would seem very logical to have our I as 10%. That is the interest rate on the new debt, right? However, under IFRS, we are required to use the original interest rate on the debt for computing the present value, And this is to increase the consistency of the comparison between the new debt arrangement and the old debt arrangement. So this is a nuance, something important to remember. We're going to use the original interest rate. So our I is actually going to be 12%, which is kind of counterintuitive because we know the interest rate on the new debt is 10%. But this is one of the rules with IFRS is that we need to use the interest rate on the original debt arrangement. However, the next thing we need to calculate is the payment. Now, we just said we're going to use the 12% as our I, which was the interest rate on the old debt over here. But when we calculate the payment is exactly whatever the lender is going to expect. So if you were the lender on this debt, you were the bank, Red Bank, what would you expect your interest payment to be? Well, clearly you would expect to receive cash of 1.9 million times 10%, because as far as you're concerned, you've just changed the terms of this debt to 10%. So even though we're using 12% as our I, our payment is still going to be the 1.9 million, times 10%, because that's what the lender is going to expect in cash. So even though our I is 12, our payment is still calculated with the actual interest rate on the debt. It's face value times the stated rate. So this is going to give us a payment of 190,000 each year. Okay, so now we have all the inputs here. We can go compute present value into our calculator. And we're going to get the present value as 1,808,730. So now we've got 1,808,730 of the new debt, and the old debt was worth 2 million. So we need to compare these two numbers to see if we've hit this 10% threshold. So if we say, okay, old debt, 2 million, new debt, or new debt arrangement. It's not a different debt. I'm not trying to imply that we have a settlement here. I'm just referring to the old way of the old debt arrangement versus the new debt arrangement. The new debt is present value is 1,808,730. So our difference is 191,270. And if we calculate the percentage difference, and what I'm doing here is I'm taking 191,270 divided by the top number, the 2 million. And this is going to give me a difference of, this is going to give me 0.95635. What does that mean? It is not 10% or more. It's less than 10%. Therefore, this is a modification. So it's not a settlement. We can't just take the old debt off our balance sheet and put the new debt on. This is seeing the old debt as continuing with different terms. So we need to look at everything as in saying it's the same debt, it's just changed. So how are we going to account for the change? Now, remember in the question, there's 2 hints that we had that we're using IFRS for the first piece, which is that it says Troubled prepares financial statements in accordance with IFRS 9. And we don't need to worry too much about the 9 part right now, but we're clearly in IFRS. We can also see that down here we're asked to do ASPE, so that's our second hint. Obviously, we're using IFRS for the beginning. And that's really important to know whether we're using IFRS or ASPE because the accounting for debt modifications is significantly different between IFRS and ASPE. And hopefully by the end of the question, that will be clear. Let's just start with IFRS for now. So, okay, so we know that it's not 10%. We know we have a modification of debt. So what's the next thing that we're going to do? Well, IFRS requires the debt to be recorded on our statement of financial position at the present value. So we know the present value is here, right? IFRS says this is what the present value of this debt is. We always record notes at the present value on our statement of financial position. Therefore, that is how we need to account for this debt. So we are going to, so right now, what's on our statement of financial position? Right now, we have the debt on our statement of financial position at this amount, 2 million. So what's happened? The debt has decreased in value. So the debt's decreased by this amount here, the 191,270. So right now in our statement of financial position, we have a $2 million debt, but that's no longer the present value of this debt with the new terms. The present value is now 1,808,730. So we need to make an adjustment to change the present value of the debt in our statement of financial position. So we're going to debit notes payable, and debiting a liability, which is notes payable, we're decreasing the value of the note payable by 191,270. And we're going to credit, actually, we're going to hit our income statement here. We're going to credit gain on restructuring, because the only way we can adjust our balance sheet or our statement of financial position is by putting the difference through the income statement. So we're going to have a gain on restructuring of 191,270, and we're going to have a note payable now on our balance sheet. Now that we've recorded this entry, we've got, this is what we had on our statement of financial position here. Now we've recorded the 191,270 to take away from it. So now we've got this as the present value of the note on our statement of financial position. So next, let's calculate our effective interest amortization schedule. So we're going to have our date here. We're going to have the cash paid. And this is always the face value times the stated rate. Whatever the note says, that's what's going to go through our cash paid. Then we're going to have our interest expense. And this is very different than what we would normally have in our bond amortization tables. It's really important to take note of this. We'll talk about that in a second. Then we're going to have our amortization and our carrying value. So what's going on with interest expense here? Well, normally our interest expense, our cash paid is always the face value times the stated rate, and our interest expense is usually the carrying value times the market rate. However, when we're accounting for a debt modification, this is going to be the carrying value times the original effective rate on the debt. So we know that the interest rate on the debt was decreased. It was 12% and now it's 10%. So I would have thought that we would include the 10% in our interest expense column. That would be normal. That's what we would have done in all of our other non-debt modification questions. However, here, this is a nuance of debt modification for IFRS. This needs to be the 12%, the original rate. So even though the interest rate on the debt is only 10% now, this has to be the original interest rate, which is 12%. So let's write down our periods here. So we're going to have 12/31/2020. So 12/31/2020, what do we have in our statement of financial position? Well, we know we have the debt recorded at the present value, which is 1,808,730. Okay, so at the next year end, 12/31/2021, now we're going to have what's the cash paid on the debt? Well, we actually calculated this above already when we were calculating our present value. Remember this, the payment. So it's going to be the face value of the debt, which is 1.9 million, the new face value, times the new rate, 10%. This is what the banks agreed with us. This is what they're going to expect us to pay. It would be really bizarre if we paid them more or less than that. So this is our payment. It's always going to be the same, and it's always going to be 190,000. Now our interest expense, which is going to be our carrying value, so 1,808,730 times 12%, the original rate on the debt is going to be 217,048. So the difference between these two things is the amortization. Now, are we amortizing a discount or a premium? Well, we know that the actual face value of this debt is 1.9 million. The present value that we have it on our statement of financial position right now is 1,808. So we're clearly amortizing a discount. So the amortization is always going to be increasing the carrying value. We know that at the end of this schedule, we need to have the debt on our statement of financial position at face value. So we know we need to end the schedule at 1.9 million. So 1,808,730 plus 27,048 is going to be 1,835,730. 778. Then our next year end, we've got 12/31/2022. Our payment never changes. Our interest expense will change. So now we've got a different carrying value. So 1,835,778 times 12% is going to give us 220,293. The difference between the cash paid and the interest expense is going to give me my amortization of the discount, which is going to be 3293. And 1,835 plus 3293 is going to give me a new carrying value of 1,866,071. And our last year end, thankfully there's not too many years here, is same payment, interest expense 1,866,071 times 12%, 223,930. The difference between the cash paid and the interest expense is 33,930. So our new carrying value then, 1,866,071 plus 33,930 is going to be 1.9 million. So if we put totals down here, so we can summarize what we've done here, is we've got our cash 3 interest payments of 190,000 means the company has paid, Troubled Ink has paid interest expense over the 3 years of 570,000. The interest expense, which has been the carrying value each period times the 12% original rate on the debt, is 661,270, which is just the sum of those 3 numbers above. And the total discount that we've amortized is 91,270. And of course, we can see that we have the note on our statement of financial position at the 1.9 million at maturity of the note, which is exactly what we need. So let's take a look back up at the question and just make sure we know where we are. So we've got determine whether or not Troubled should record a gain. So whether or not they would record a gain would be whether or not there was a modification or a settlement of the debt. We've determined that it is a modification, and we did record a gain. Remember right here, we recorded a gain under IFRS because we needed the note payable on our statement of financial position at the present value of the new debt arrangement. So we had to decrease it from the 2 million that it was recorded prior to the changes. So that's why we recorded a gain on restructuring. So that's part A. We've got the entry, you just saw the entry that we've recorded with the debit to the note payable, the decrease to the note payable, and the gain on restructuring. Prepare an effective interest amortization table for the remaining term of the note. We did that. And next we're asked to prepare the interest payment entry for Troubled on December 31st, 2022, and the entry on January 1st, 2024. Okay, so let's do those journal entries here. So we're asked to prepare the journal entry for this period, 2022, and the maturity of the note, which is January 1st, 2024, one day after our amortization schedule. So we're going to have our interest expense journal entry for interest expense at 12/31/2022. So we're going to have debit interest expense. So interest expense is going to go through the income statement of Troubled Ink. And of course, this is going to be this number, 220,293. And is it 2022? Let me just double check. One sec. Yeah, 2022. Okay. And then that's the right period. And then we're going to have credit note payable, because as we're amortizing a discount, we're increasing the value of the note payable each period to get closer to that 1.9 million. So our credit to the note payable is going to be this number, 30,293. And we're also going to credit cash for the payment that we're making to Red Bank. We're going to issue a check to Red Bank for 190,000. So that's what our entry looks like for the recognition of interest expense. And of course, just like any note payable, the cash payment that we make to Red Bank is not what our interest expense is. Our interest expense is a calculated number for accounting records. And the journal entry at maturity is going to be very simple. It's just going to be debit, note payable. We need to remove the note payable from our balance sheet. And we've got it on our balance sheet at maturity at 1.9 million, like we just saw in our amortization schedule. And credit cash. Of course, Red Bank is going to want their 1.9 million back. And that's what we're going to record at maturity. And it does say that Red Bank had enough money to make that payment. Because if we go way up in the question, we've got on January 1st, 2024, Troubled Inc. pays 1.9 million in cash to Red Bank, meaning that they did come up with the funds to repay the face value of the note. Okay, so we did D. So now let's take a look at E. So E says, assume instead that troubled follows ASPE. Calculate the rate of interest that troubled should use to calculate its interest expense in future periods. Continuing the assumption of following ASPE, prepare an effective interest amortization table for the remaining term of the note. And continuing the assumption of following ASPE, prepare the interest payment on December 31st, 2022, and the entry on January 1st, 2024. Okay, so let's just change the color here to recognize that we're following ASPE. So we know what's happening under IFRS. And let's talk about ASPE first. Let's just talk it through and then we'll do some writing. So under ASPE, this part here is the same. So we would have still calculated whether the present value of the new debt arrangement was more than 10% different than the old debt arrangement. Same deal here. We still would have come up with the fact that it wasn't more than 10% different. So we would have been in the modification. So that would have been exactly the same if this question had just been using ASPE and we weren't doing IFRS. Completely the same. Where ASPE gets different than IFRS is this entry. This is the entry that we recorded under IFRS to record the present value of the note payable on our statement of financial position on day one. Now, ASPE does not record this entry. ASPE, instead of saying where IFRS said, listen, we want the note on our statement of financial position at this present value of 1,808,730, ASPE says, no, this is a continuation of old debt. It's not new debt. So I have $2 million of note payable on my statement of financial position right now, just like under ASPE, or just like under IFRS, sorry. But I'm not going to change that amount on day one. ASPE says there should be no P&L impact on day one. It doesn't agree with IFRS that you would have this gain on restructuring. There's no gain on day one under ASPE. The way that we recognize the fact that the terms of the debt have changed is through the interest rate that we're going to use. So looking down at our amortization schedule we had here using IFRS, remember how we had this interest expense under IFRS, which was the carrying value of the debt times the original rate? Well, ASPE doesn't use the original rate. ASPE says, no, I don't know what the interest rate is on this debt. I need to calculate that. So ASPE is not going to use 10% and it's not going to use 12%. It's going to impute its own rate. And that's going to be what changes our amortization schedule. So let's go down and start with that. So ASPE says, okay. So there's no gain on restructuring. So ASPE says, okay, let's figure out impute the interest rate on the new debt. New debt arrangement. Again, it's not different debt, it's just a new debt arrangement. So, and the way that ASPE does this is it equates the carrying value, of the original debt with the present value of the revised cash flows. And what does that mean? It's kind of cryptic, right? So let's calculate it and then hopefully it'll be more clear. So what's the present value of the new debt arrangement? Now, it would be reasonable to say that it's 1.9, but actually in IFRS, we didn't know this was what we had to calculate. We know that, but under ASPE, we say, well, the present value of this debt has to be 2 million because that's what I have on my balance sheet. And this is just a continuation of the old debt. So the present value of the old debt was 2 million. So we're comparing the present value of the old debt with the cash flows from the new debt. So this is the old debt. But this is what we include in our calculation to compute the interest rate. So just the present value of the new debt, and then everything else is going to be for the revised debt arrangement. So the N is going to be 3. Our payment is going to be 190,000, just like we had above, which is 1.9 million, the face value of the new debt, times the 10%, which is the new interest rate. This is what Red Bank is going to expect, and this is the exact same between IFRS and ASPE. And the future value of the debt is going to be 1.9 million. 1.9 million. The payment and the future value we need to be negative in this calculation. And then we're going to go compute I. So if you type that into your financial calculator, present value 2 million, N3, payment negative 190,000, and future value negative 1.9 million, you will get a interest rate of 7.96%. 7.96%. Okay. So, and actually, if we want to extend this out, it's actually 7.9592%. So rounded 7.96, 7.9592. Okay, so now we know, so under IFRS, we were discounting, we were recognizing interest expense at 12%, whereas now we're saying the interest rate that we're going to use for interest expense is 7.959 or 7.96%. So there's no gain. All we've done is calculate a new interest rate. Okay. So now we're asked to create an effective interest amortization schedule. So what's that going to look like? So we've got date, of course. We've got cash paid, which is the face value times the stated rate. And we've got our interest expense, which again is special. Let's talk about that in a minute. And then we've got the amortization and the carrying value. So our interest expense here is going to be the carrying value times this rate up here, our imputed rate, okay, times imputed rate. Imputed rate. That's not very clear, but it says imputed rate. Okay. So this is another nuance. So in IFRS, we had our interest expense was the carrying value times the original rate. Now under ASPE, it's our carrying value times this imputed rate. And there's one other really important difference is what is our original carrying value going to be? So let's put in the date here of 12/31/2020. Now remember in ASPE, if we go up here, our carrying value on day one was 1,808,730. And the way that we got there is because we recognized this gain. Without this gain, what would our carrying value have been? Our carrying value would have been 2 million. In ASPE, we haven't recognized a gain. So our carrying value is going to be, what happened here? Our carrying value is going to be 2 million. So we're starting off with a carrying value of 2 million. And then December 31st, 2021, we're going to have cash paid of 190,000. We're going to have interest expense. So it's going to be 2 million times 7.959%, which is going to give us 159,184. The difference between 190 and 159,184 is going to be 30,816. So our new carrying value is going to be 1,969,184. 184. Okay, so then 12/31/2022, we're still going to have this payment of 190,000 that never changes. Our interest expense is going to be 1,969,184 times 7.959%, which is going to give us 156,731. The difference between 190 and 156,731 is going to be 33,269. And 1,969,184 plus 33, actually minus 33,269. Let's talk about that for a second. So the carrying value of this debt on day one is 2 million. What do we need it to be on our balance sheet at maturity? Well, we need it to be at 1.9 million because that's what we're going to have to pay back to Red Bank on January 1st, 2024 or December 31st, 2023. So if we have it at 2 million, then clearly we're amortizing a premium because we need each of these amortizations to be decreasing the value of this debt on our balance sheet so that we're getting down to 1.9 million. So each time we have this amortization, we're actually subtracting it. So it was 2 million minus 3816 gave me 1,969,184. And 1,969,184 minus 33,269 is going to give me 1,935,915. And then 12/31/2023, same payment, 190,000. Now I've got 1,935,915 times 7.959%, which is going to give me 154,084. The difference between 190 and 154,084 is 35,916. So 1,935,915 minus 35,916 is going to give me 1.9 million, which is perfect. That's exactly what I needed this to be on my balance sheet at maturity, which is this December 31st, 2023, or the next day, January 1st, 2024. So let's just run totals here so we can see what happened. So the cash paid was 570,000. The our total interest expense, the sum of these three numbers, is 470,000. And the amortization of the premium is 100,000. And we've got the note on our balance sheet at maturity. So let's go back up to the question. Let's just see what we've addressed and what we haven't. Okay, so we calculated the rate of interest that Troubled should use to calculate its interest expense, which was that 7.96%. Continuing the assumption of following ASPE, prepare an effective interest amortization table. We did that. And now we need to do these journal entries. So continuing the assumption of following ASPE, prepare the interest payment entry for Troubled on December 31st, 2022, and the entry on January 1st, 2024. So let's do that. So then let's go journal entry for interest expense on 12/31/2022. I think it was 2022, wasn't it? I always forget that number. 2022. Yep. Okay. So, okay. So our journal entry for the interest expense is going to be, of course, debit interest expense. And we're going to pick up the numbers right from this line here in the table. So my interest expense is 156,731. Now I'm going to be debiting the note payable because I'm decreasing it each period, which is what happens when you're amortizing a premium. So now I'm debiting the note payable by 33,269. And then my credit is going to be to cash for the amount that I'm paying to Red Bank. And this is going to be 190,000. Okay, my journal entry at maturity is going to be the exact same as my journal entry under IFRS. It's going to be debit note payable because we need to remove the note payable from our balance sheet, 1.9 million, and credit cash for 1.9 million, because who cares whether we're following IFRS or ASPE? Red Bank wants their 1.9 million back. Okay, let's pause here and let's talk about the differences between debt modification accounting for IFRS and ASPE. Okay, so let's change my color. Okay, so either way, under IFRS, whether we're accounting for debt modification under IFRS or ASPE, the first thing we need to do is figure out whether we've hit this 10% threshold or not. The 10% threshold is the difference between the present value of the new debt, the present value of the old debt. If it's over 10%, then we're into settlement accounting, which we're not doing in this question. In this question, we didn't hit the 10% threshold. We were close, 9.5%, but not 10%. So this was a modification of debt. That's the same between IFRS and ASPE, is figuring out if that threshold has been crossed. In this question, that threshold wasn't crossed, so we're in modification. Now, IFRS records this entry on day one of the debt modification, which is to change the value of the note payable on the statement of financial position and recognize a gain through the income statement so that the debt is recorded on the statement of financial position at the new present value from day one. IFRS does not do that. IFRS says, listen, this is still the same debt. There's no gain that should be going through the income statement. So rather than recognize a gain, we're instead going to impute a new interest rate by using the present value of the old debt and then using the cash flow information from the new debt to impute an interest rate. And that interest rate is what was used for interest expense. So because we didn't record a gain through the income statement, the debt, even though it was the new debt, was still recorded on the balance sheet under ASPE at 2 million on day one, even though we know that we only owed Red Bank 1.9 million at maturity. And then the premium was amortized down so that the debt was still on our balance sheet at 1.9 million at maturity. Same thing with IFRS, but what we were doing here is that we were amortizing a discount. So the debt still ended up on our statement of financial position at 1.9 million at maturity. So we got to the same place there. Now let's compare what went through the income statement under IFRS and ASPE. So let's compare the income statement. So if we have IFRS here, and then we have ASPE here, what happened? So IFRS, we recorded a gain, which was a positive impact to the income statement. And we had a gain that we recognized on day one, and it was 191,270. And ASPE did not have this gain. Now the interest expense that went through the income statement, which is part of our effective amortization schedule, is obviously negative impact. It's a debit to an expense through IFRS and ASPE. So what was the total interest expense that we recognized through IFRS? Let's scroll way up and check that number. Here we go. So remember how we put these totals through, and we had our interest expense here under IFRS, which was the carrying value times the original rate, that 12%, that was the interest rate on the debt before the terms were changed. Well, through our amortization schedule that got us to the 1.9, the total interest expense that went through the income statement under IFRS was 661,270. So let's put that into our table here. So we had interest expense of 661,270. Now, ASPE, we didn't have a gain, but what was the interest expense that we recognized through our amortization schedule? And remember here, our interest rate, our interest expense was the carrying value times our imputed rate. So it was not the 12% that we used in IFRS. It was an imputed rate, and our rate was 7.959. Well, our total interest expense in our schedule based on our totals here was 470,000. So we'll put here 470,000, and that got everything on our balance sheet at the right numbers, the 1.9 million at maturity. So our total impact to our P&L here our gain and then our interest expense. You can see our interest expense was higher under IFRS and lower under ASPE because we use different rates. So at the end, the total that went through our income statement here was we had an expense of 470,000, which is the sum of those two numbers. And here, clearly it's just 470,000. So what this shows is that we got to the exact same place on our income statement under IFRS and ASPE. So under IFRS, first we started out with income, and then we had a larger interest expense each year for a total over 3 years of 661,270. ASPE, no gain, so no income statement impact initially, but over the 3 years we had lower interest expense. So we ended up hitting the P&L for 470. So there's no difference as to whether or not the income statement's higher or lower between IFRS and ASPE by the time the debt matures, which in this case was 3 years. What is different is year 1, year 2, and year 1 and year 2, you would have different income. Your income statement would look different, but by the time the debt matures, everything's washed through and we're at the exact same place. So if a company was trying to decide whether they wanted to use IFRS or ASPE to account for debt, and they knew that they were going to have a debt modification, then ultimately it would really just depend how focused they were on the short term versus the long term, because the long term makes no difference. In the short term, your income statement under IFRS will look better, at least in year 1. And then in year 2, you start to get pretty close. And year 3, you're exactly the same. Okay. So, and if we look, one more thing, if we look at the cash paid, of course, we know that our payments were 190,000 under ASPE and under IFRS. Of course, the payments were, the total of the 3 years was 570,000. And here the total of the 3 years was 570,000. So obviously the payment that we're making to Red Bank under either type of accounting is exactly the same. So the only difference is the interest expense, and of course, which impacts the amortization of the premium or the discount either way, but ultimately the interest expense is what hits our income statement. The amortization is a balance sheet account. So the interest expense, the P&L impact is exactly the same under the two methods by the end of the 3 years. One key note here is that this question just gave us two rates. It gave us the original interest rate on the debt, and it gave us the new interest rate on the debt. What if it had said in comma here, the current market rate is 9%? What would we have done with that information? Nothing. We would have ignored that. Normally, we use the market rate for our effective interest amortization schedules for interest expense, but for debt modification, we don't use the market rate. All we're interested in is the original rate and the new rate so that we can calculate out the payment. So we would not use the market rate. If there was a market rate given, that's just a trick. So you can just disregard that. We're looking for the original interest rate. For ASPE, we need the 10% to calculate out our payment, and IFRS is going to impute a new interest rate anyway for the interest expense. Okay, I think we did this here. So that concludes part 1 of this question. We'll cover part 2 in the next video.